Imagine if your city could mint its own digital currency, turning everyday residents into stakeholders who mine tokens to fund public projects, boost local economies, and even influence governance decisions. Sounds revolutionary, right? But as we've seen with recent launches, the line between innovation and catastrophe can be razor thin. Welcome to the generational wealth community, your pathway from knowledge to legacy. Today we're diving deep into CityCoins, the ambitious project that's captured headlines for its bold vision of city-backed cryptocurrencies, its early successes, and its more recent stumbles. We'll explore how it works, its history, the latest developments in 2026, what it means for investors and urban economies moving forward. Stick around because this could reshape how cities fund themselves in the blockchain era. Let's start with the basics. CityCoins is a decentralized protocol built on the Stacks blockchain, which itself layers on top of Bitcoin for added security. The core idea is simple yet powerful. Create city-specific cryptocurrencies that residents can mine and stake to generate rewards, with a portion of those rewards flowing directly into the city's treasury. This isn't just about trading tokens. It's about fostering community involvement. For instance, miners contribute computing power to the network, earning CityCoins in return, while staking those coins can yield additional benefits like governance rights or even real-world perks tied to the city. The project kicked off in 2021 with MiamiCoin, symbolized as MIA, which quickly became a poster child for crypto adoption in government. Miami's embrace was spearheaded by then-Mayor Francis Suarez, who positioned the city as a crypto hub. By early 2022, MiamiCoin had generated over $22.5 million for the city's coffers, according to reports from the block. This windfall came from the protocol's design, where 30% of mining rewards are automatically forwarded to a city-controlled wallet. It's convertible to dollars for public use. Miami used some of these funds for initiatives like affordable housing and tech education programs, showcasing how crypto could directly impact real-world infrastructure. Following Miami's success, the project expanded to New York with NYCCoin, or NYC, launched in November 2021. The community-driven rollout saw enthusiastic support from New York Mayor-elect Eric Adams at the time, who tweeted his approval and even suggested taking his first paychecks in Bitcoin to signal pro-crypto stance. But fast forward to 2026, and the landscape looks markedly different. The original CityCoins project faced significant headwinds in the intervening years, including market volatility, regulatory scrutiny, and waning community interest. Many early adopters saw token values plummet. MiamiCoin, for example, which once traded at peaks around 5 cents, has struggled to maintain momentum amid broader crypto winters. Similarly, NYCCoin experienced sharp declines, with holders voicing frustrations over unresponsive city officials and unfulfilled promises of fund utilization. In fact, millions in protocol rewards sat dormant in city wallets for years. It was highlighted in community discussions on platforms like X, where token holders voted to reclaim funds but hit bureaucratic roadblocks. Despite these challenges, the concept of city-backed tokens hasn't faded entirely. Just last month, in January 2026, former New York City Mayor Eric Adams made waves by launching a new initiative called NYC Token. This wasn't a direct revival of the original NYCCoin, but a fresh cryptocurrency aimed at combating anti-Semitism and anti-Americanism, according to Adams' announcement in Times Square. The token surged to a nearly $600 million valuation within minutes of its debut, drawing in eager investors chasing the hype. However, the excitement was short-lived. By that evening, the value had plummeted by 75% after a major account withdrew $2.5 million, reported by NBC New York. Critics labeled it a potential rug pull, with ex-users pointing out similarities to past failed CityCoin attempts, including at least 6 prior NYC-themed tokens since 2014 that ended in rugs or collapses. So, what's driving this renewed interest in 2026? For one, the broader crypto market is maturing, with institutional adoption pushing for real-world asset tokenization. Cities are exploring blockchain to streamline funding without raising taxes, especially as urban budgets strain under inflation and infrastructure needs. Trends like decentralized finance and Web3 governance align perfectly with CityCoin's model, where tokens could eventually enable voting on city proposals or discounts on local services. Moreover, with Bitcoin consolidating around $70,000, and Ethereum hovering near 2,300. As per recent market reports, altcoins tied to tangible assets like city economies are seen as a hedge against pure speculation. Analysts predict that if regulatory clarity improves, such as the proposed U.S. crypto market structure bill potentially passing this year, more cities could adopt similar models. Predictions from contributors like Patrick Stanley suggest over 200 cities might have their own cryptocurrencies within 5 years, per CoinMarketCap interviews. That said, the risks are undeniable. Volatility remains a core issue. Prices can swing wildly based on market sentiment, as evidenced by the NYC token crash. Regulatory hurdles persist, with questions around whether these tokens qualify as securities or commodities. And let's not forget the human element. Projects like this rely on active community participation and transparent city involvement, which hasn't always materialized. For investors, due diligence is key. Look at circulating supply, which for MiamiCoin stands at around 3.5 billion tokens, and check liquidity on exchanges like OKCoin, where trading volumes have ebbed in recent years. Looking ahead in 2026, CityCoins could pivot toward integration with emerging tech like AI-driven governance or NFT-based city assets. If cities like Miami or New York actively deploy their accrued funds, potentially tens of millions more, it could validate the model and attract fresh capital. Trends point to a blend of utility and speculation, where tokens aren't just traded but used for everyday perks, like paying parking fees or supporting local charities. But success hinges on avoiding the pitfalls of hype-driven launches, as seen with Adams' recent venture. In summary, CityCoins represents a fascinating intersection of blockchain and urban innovation, with early wins in funding but lessons learned from failures. As we navigate this evolving space, remember that knowledge is your greatest asset in building generational wealth. Subscribe for daily recaps, drop a comment on your biggest takeaway, and turn on notifications. We do a crypto news video every morning and a deep dive every afternoon. Let us know in the comments any subjects you'd like us to cover. Quick disclaimer, I'm not a licensed financial advisor. This is for educational purposes only and not financial or investment advice. Crypto is volatile. Never invest more than you can afford to lose. Do your own research.